Good evening, ladies and gentlemen. This is Barry Norman on behalf of Valvexo and Investing.com, and welcome to our webinar on market analysis. I hope everybody's having a good evening and had a good day. Now, tonight's class is sponsored by Alvexo, one of the world's leading Forex brokers and investment companies. They are one of the best platforms that you can possibly trade with and one of the best brokers. And on top of it, Avexo is a regulated provider. As you see, here's their license number up on the screen, and they are regulated by CISIC, which passports them all throughout Europe. Now, they have one of the most advanced web trader platforms. They get real-time quotes. You can have one-click trading, all types of order entries, high-speed execution, and incredibly great security. Now, Alvexo will make sure that your trading experience is one of the best in the industry. But if you want the old-fashioned, well, not the old-fashioned, the highest technology, but you'd like to trade with the downloadable MT4 platform, you can also use the MT4 platform with Alvexo. You can have the most advanced charts in the marketplace. You can connect your AIs. You can do everything with the MT4 platform on the Alvexo site. They also issue signals to you free of charge. Their trading signals are compiled twice a day using their own algorithms, and they have an 88% accuracy, and they're available to all of their traders. They also have live customer support. They have the highest leverage to margin the regulators provide and available to you. They have an exceptional trading academy and a full array of all types of tools to help you trade better. So remember, go to www.alvexo.com and open up a demo account today and just try them out. There's no credit cards required, no bank deposit required. Just fill out 3 little lines on the site and you'll be up using their demo platform right away. And if you like it, then you can switch over to real money. So again, go to www.alvexo.com and give them a try. It's one of the best platforms you can possibly use. Now, tonight's class is also co-sponsored or powered by Investing.com. So again, welcome to our class on market analysis. Now, fundamental analysis is one of the 2 schools or 2 sciences that are used to evaluate securities. The other is technical analysis. Now, fundamental analysis is a method of evaluating security in an attempt to measure its intrinsic value. Whether you're looking at Forex, whether you're looking at commodities, or whether you're looking at stocks, there are different ways to weigh and determine the value of each. Now, fundamental analysts study anything that can affect the security's value, including economic factors such as the overall economy and industry conditions, or as well, if you're looking at stocks, earning reports. If you're looking at commodities, the production of the commodity, if you're looking at corn, how much is the crop this year? If you're looking at orange juice, what are the USDA estimates? So you have to understand the fundamentals of the particular asset you're looking at. But the end goal of fundamental analysis is to produce a quantitative value that an investor can compare with the security's current price, thus indicating whether the security is undervalued or overvalued. Okay. Let's go back to my orange juice example. If orange juice is priced at $1.49 and the market supply is full, there's a good chance that it's overpriced. And if the crop reports come in and say it's going to be a booming crop, what's going to happen? The price is probably overvalued. Okay. If the crop report comes in and is lower than expected, it's most likely that the asset or orange juice is undervalued and will climb upward. Okay. Now, fundamental analysis study everything from the overall economy and industry conditions to the financial condition and management of companies. Technical analysis is the evaluation of securities by means of studying statistics generated by market activities such as past prices and volume. Technical analysis is thought to be the scientific end of it, where fundamental analysis is stuff that we can understand easier. It's a lot of times stuff we know. Now, fundamental analysis uses real public data in the valuation of a security's value. Although most analysts use fundamental analysis to value stocks, this method of valuation can be used for just about any type of security. So you can use fundamental analysis for stock markets, for commodities markets, for the Forex market, for indices. There are all different kinds of fundamental analysis. For example, an investor can perform fundamental analysis on a bond's value by looking at the economic factors such as interest rates and the overall state of the economy. He can also look at information about the bond issuer, such as potential changes in credit ratings. For stocks and equity instruments, this method uses revenues, earnings, future growth, return on equity, profit margins, and other data to determine a company's underlying value and potential future growth. In terms of stocks, fundamental analysis focuses on the financial statements of companies being valued. Now, what happens is when we mention the word fundamental analysis, for some reason, everybody only thinks about the economics calendar, and they only start to think about the major government data. But this is only one type of fundamental analysis. Fundamental analysis is built on the idea that the market price of a security can be wrong from time to time. Profits can be made by finding underpriced assets and waiting for the market to adjust the value of the company or the asset. By analyzing financial reports from companies or economies, you can get an understanding of the value of different assets and understand the pricing in the market. After analyzing these factors, you have a better understanding of whether the price of a security is undervalued or overvalued. Fundamental analysis can also be performed on the sectors basis and in the economy as a whole. Now, you have to remember there are different types of data for different types of markets. In the stock market, we look primarily at earnings statements. We look at press releases. We look at sales of a particular item. If for Apple, we're going to look at sales of iPhones, but we're also going to pay attention to the overall sales of mobile phones, the growth of the mobile industry. Okay. In Forex, we're going to be more concerned with what? Central banks' interest rates. For commodities, we're going to be interested in all types of things like government crop evaluations, whether there's a strike in a port, crude oil. We're looking at crude oil inventories all the time. We're looking at global supply and global demand, and we're also paying attention to geopolitical situations. So you have to be aware of what data is available that will affect the market that you're looking at and where you can find this data. Now, in the stock market, we look at specific things. And there's some real basic stuff you should look at to perform market analysis of any stock. Now, for a fundamental analyst, the market price of a stock tends to move towards its intrinsic value, which is the true value of a company as calculated by its fundamentals. If the market value does not match the true value of the company, there is an investment opportunity. Example of this is that if the current market price of a stock is lower than the intrinsic value, the investor should purchase the stock because he expects the stock price to rise towards its true value. Alternatively, if the current market price is above the intrinsic price, the stock is considered overbought and the investor should sell. Well, that's almost common sense. But how do you evaluate a stock to determine this? So we're going to start out tonight looking at stocks, and then we're going to go over and look at how you would evaluate or what you would use to evaluate currencies and commodities. And we'll go through each one of these markets. Now, the true value of stock, there are alternative types of investment styles that can be applied to different stocks. So you have to also, in the stock market, be aware of how you would evaluate it and also the type of investment you're using. because sometimes you're looking for very short-term fundamentals, or other times you're looking for longer-term fundamentals. Okay, especially in stocks, you have value stocks, growth stocks, and income stocks, and they are evaluated slightly differently. Value investing is an investment style that focuses on buying a stock that is undervalued according to a fundamental analysis, and hold that stock until it's reached its true value. Accordingly, value stocks are presumed to be traded at a discount to their value. Whereas growth investing consists of identifying stocks that have exhibited faster than average earnings growth over the previous few years compared to the market, and are furthermore expected to continue their earnings in the coming future. Growth stocks are thought of as a riskier than average stocks since they usually have a higher price to earnings PE ratio and pay little or no dividends. And then lastly, we have income investing. Income investing consists of identifying stocks that pay relatively high and regular dividend payments to their shareholders. Well-established income stocks often have a long history of paying out dividends. So if you're looking at a dividend stock, you're looking for other factors. For instance, but here is where the economy and the overall economic situation of a country can have a big effect on income investing, because when we had the financial crisis hit in 2008, most of these companies that are income you did income investing, stopped declaring dividends. And that really hurt because they moved from being stocks you should keep in a income portfolio and moved over to different areas. So some sectors are known as income generating stocks and are popular for income investors. These are such things as gas and electric, telecommunication, real estate investment trusts, financial or insurance sectors. Now there's 5 key factors we look for in evaluating share prices, or the 5 key fundamentals. The first thing we should be aware of in stocks is earnings. Okay, earnings is kind of easy for us to understand. The key element all investors look after is earnings. Before investing in a company, you want to know how much the company is making in profits. So what is that? That's the fundamentals of a company. It comes from their income statement that's issued, or their earnings statement that's issued every quarter. But they can also be issuing warnings during the quarter. Like they intend or they think they're going to miss earnings. Okay. When retail sales are terrible, you would expect big retail companies like Walmart might be losing their sales and miss their earnings expectation. So factors determining earnings for the companies are such as sales, costs, assets, and liabilities. A simplified view of earnings is earnings per share, or EPS. This is a figure of the earnings which denotes the amount of earnings for each outstanding share. We also want to look at profit margins. The amount of earnings does not tell the full story. Increasing earnings are good, but if the costs increase more than the revenues, then the profit margin is not improving. So what you're delving into is the fundamentals or the market analysis of a company. Because if you look from 2008 to 2017, a lot of companies were able to keep their earnings in line with market expectation or keep increased earnings. But what they were doing, they were cutting costs. Okay. And what you saw was less revenue. Okay. So by cutting their costs, they generated higher profits and earnings, but overall it wasn't a good scenario for the company. So we want to look at profit margin, which measures how much the company keeps of its earnings out of every dollar of their revenue. This measure is therefore very useful for comparing similar companies within a similar industry. Higher profit margins indicate that a company has better control over its costs than its competitors. An easy example of this is if company A and company B both generate net profits of $1 million, but company A has equity of 100 million and company B has equity of company A has 10 million and company B has 100 million, their ROE or return on equity would be 10 to 1% respectively. So you would expect a $100 million company be generating more net profits net profits than a small $10 million company. Now, return on equity is quite important. Return on equity is a financial ratio that does not account for the stock price. Since it ignores the price entirely, it is by many thought of as the most important financial measure. It can basically be thought of as the parent ratio that always needs to be considered. Because even though stock price has a difference to you and me if we're going to invest in a company, or it is not the crucial element in determining the health of a company. Okay. So the reason for return on equity being so important is because it contains several important factors such as leverage, revenue, profits, and margins, returning value to shareholders. Good approximation of an ROE should be between 10 to 40% greater than its peer. Then we also want to look at price to earnings. When taking in the current market price into consideration, the most popular ratio is price to earnings. Okay. As the name suggests, it's the current market price divided by its earnings per share, EPS. And it is an easy way to get a quick look at a stock's value. A high PE indicates that the stock is priced relatively high for its earnings. This ratio does not tell the full story since it does not account for growth. And this is, again, one of the key elements. We have to look at what we're looking for: value, growth, or income. According, if a company is growing rapidly and is expected to maintain its growth in the future, this current market price might not be so expensive. This is the reason for the existence of the different types of investment styles. So in other words, a company like Facebook that has huge growth, very, very fast growth, would be evaluated differently than a company like British Telecom that has been established for a long time. And is not experiencing huge growth. It's maybe a value share. But you have to look at these numbers in relationship to the type of company it is and the type of investment style. Okay. While some sectors normally have low PE measures, other sectors commonly have higher ratios. For example, utilities commonly have PEs ranging from 5 to 10, while technology companies commonly have PEs ranging between 15 to 20. So you have to make sure at all times you're comparing apples to apples and you're watching the sector, the market sector in, to understand that you're getting the right value. So it's not very appropriate to compare Apple with GDF Suez. They're a small little company, okay, where Apple's a good, big, growing technology company. GDF Suez is an energy company, as Apple has a growth rate of 11 times more than GDF. It is more appropriate to compare Apple with Google. In that relation, Apple seems cheaper than Google by the look of the PE. Now you should ask yourself, why could that be? Is this a bargain, or are some other reasons why Apple is priced lower than Google? One suggestion might be that the market expects Google to have more earnings growth in the coming future, and Apple's previous earnings growth is now not expected to grow as fast. Now you also have to realize, even though they're both in the technology sector, Apple is more of a manufacturer and supplier. Okay. So again, you have to see Okay, then you have to make sure you're comparing the same oranges to the same oranges or the same apples to the same apples. In order to account for growth, the PE ratio can be modified into the price earnings to growth, the PEG ratio, which is a little bit better. A PEG ratio is calculated by dividing the stock's PE ratio by its expected 12-month growth rate. And this will give you a more precise factor. But stock markets as well as Forex markets are also affected by economics data. So you can't just blindly pay no attention to what is happening in the economy when you're evaluating a stock. And when you're trading somewhere else, you need to be aware of how all of these affect, because the value of the US dollar also has an effect on the growth of a company, or the value of the euro. When it's a U.S. company, the U.S. stock, and they're looking at doing exports to Europe, and they have lots of European offices, and the euro is very weak, sometimes that flow of currency and the misvalue of the currency or the decline of the currency or the currency exchange rates can have an effect on the value of a company. So you can't look at it blindly. So one of the most interesting trading strategies that Forex traders commonly employ is trading on economics news releases. Specifically, closely watch economics news items such as the United States Farm Payroll Report, which we had last Friday, okay, and which was a very good report but had very little effect on the US dollar, but had a much stronger effect on the stock market. Then we have gross domestic product numbers. There's all kinds of news and economics data that will affect the Forex market, which then relatively flows over to the stock market. News and economic data are the main drivers of market development, but in a little different way than traders think. While many novice traders expect important economic events and news releases to be reflected on the immediate price immediately, complain about the irrationality of the markets when it doesn't occur, and protest that trading the news is not possible. Well, it is, but you have to understand what the news is and how it affects everything. And unfortunately, too many traders do not understand the inner workings of these news data. They just see, we have the U.S. non-farm payroll report. It's coming out. It's a big event. It's coming out on Friday. Oh, and that number is really good. We should expect the dollar to go up and gold to go down. But they don't understand why. And therefore, they get messed up in how the markets react. The market reaction to any type of data is unpredictable. And this is the same thing in earnings reports. For instance, last quarter, Walmart's sales and earnings missed expectations, but the stock went up. Why? Because if you had looked a little bit deeper, their online growth was significant. So they're becoming a monster in online trading, which is where the markets are pushing, which means that they can slowly start cutting back stores and overhead costs, and they can stop opening as many stores as they're growing bigger and bigger in the online network and moving to the future of the industry. And their growth in online sales and their online positions supported stock growth. Sometimes it's not even possible to predict how volatile market reactions will be to news releases. Sometimes the market will move within a range of 50 more pips in the response to data releases. Sometimes a 100-pip movement in the span of 1 or 2 minutes will be reversed and completely negated by the price action during the rest of the day. Now you have to remember, each country around the world releases its economics data. These have major effects on commodity prices as well as stock prices, as well as global indices and Forex prices. Now, you have to understand what each of these reports are and how they affect the exchange rate and what they all ultimately affect, because they all ultimately affect central banks' interest rates. And so the crux to this is, how will this affect the central bank and how will it overall affect the economy? And you have to understand how inflation, runs to interest rates, how public debt affects interest rates, how public deficit, how it affects the money flow. So one of the most important events we watch all the time is inflation rates. Okay. And this is a part of your fundamental analysis. Change in market inflation causes change in currency exchange rates. A country with a lower inflation rate than another will see an appreciation of value of its currency. The prices of goods and services increase at a slower rate where inflation is low. A country with a consistently lower inflation rate exhibits a rise in currency value, while a country with higher inflation typically sees depreciation in its currency. And higher inflation rates have an effect on what? Well, they'll have an effect on retail sales, but they also have an effect on stock prices. Because it means if you're in manufacturing, your costs of goods are going to go up. If you're in services, your cost of services or your raw materials will go up. So you have to be aware of inflation at all times. It will have an effect throughout the market. Then interest rates. Now, almost all of this flows back to how the central bank is going to react. Changes in interest rates affect currency values and dollar exchange rates. Forex rate, interest rates, and inflation are all correlated. Increases in interest rates cause a country's currency to appreciate because higher interest rates provide higher rates to lenders, thereby attracting more foreign capital, which causes a rise in exchange rates. So we're talking about money flow. Okay, then we're talking about a country's current account or balance of payments. A country's current account reflects balance of trade and earnings on foreign investment. It consists of a total number of transactions, including its exports, imports, and debt. A deficit in a current account due to spending more of its currency and importing products than it is earning through the sale of exports causes depreciation. Balance of payments fluctuate the exchange rate of its domestic currency. Then we have government debt. Government debt is a crucial factor when determining the value of a currency or an indice or basically a commodity based on where that commodity is coming from. Government debt is public debt or national debt owed by the central government. A country with government debt is less likely to acquire foreign capital, leading to inflation. So it ties back to inflation, which ties back to the central bank lending rate. Foreign investors will sell their bonds in the open market if the market predicts government debt within a certain country. As a result, a decrease in the value of the exchange rates. So you always hear them talking about the U.S. debt because it's so high. It's one of the few countries that can run a debt that high. But whenever you talk about government debt, what happened when we saw Greece, we saw Italy, we saw Spain, all of a sudden they couldn't sell their debt in the public marketplace because their debt was too high and there was no way that they could pay back their debt. It killed the euro. It killed their economies because they were not attracting any more foreign capital. It all stopped the economy, and it's all one big wheel. Now, related to current accounts and balance of payments is the terms of trade, which is a ratio of exports to imports. We're always concerned with is the country importing more goods than it's exporting? Like we've seen, this is the big shift with China. Okay, China is slowly trying to change its economy to increase its imports while maintaining its exports. But while you're increasing your imports, it has a direct effect on your terms of trade. And the result in higher revenue, which causes a higher demand for the country's currency and an increase in its currency value. This results in an appreciation of the exchange rate. Now, there is all types of reaction to these news events. During a news release, a number of speculators will react immediately, hoping to gain a quick profit and exit. These will create very brief balloonings of spreads and volume in the immediate term, but also will distort the underlying technical picture greatly. As these initial buyers and sellers exit, momentum traders, which are different than value traders, which are different than growth traders, these are short-term traders that are usually trading currency or commodities, okay, will attempt to join in and fuel a more sustainable short-term trend with their action. Depending on the time and liquidity in the market, they may well be successful, but sometimes they too are checked by previously unknown order layers that check the advance of the price. When these absorb the momentum traders and the short-term speculators' entrance, the initial reaction of the price may also be reversed or negated also. Now, this is what happens. You have the initial knee-jerk reaction to the markets. And this doesn't matter whether it's really a Forex or a commodity or a stock. When you have that initial earnings report, you'll see when the headline figures that initial earnings report and Apple comes out and their earnings are higher than expected, you'll see their shares shoot back up. But as the more informed traders start entering the markets, they'll negate that because then they start looking under the cover. They look at secondary. They start analyzing, and they'll offset that. And this is when the market will sometimes negate that whole increase and just go back to right where it was. Okay. There are three ways of trading the news. Now, one of the interesting ways is to straddle both sides of the market. Some traders position themselves on both sides of the market before a significant release using a hedged position. They wait for a number to come out and then proceed to trade out of the position. For example, they might take a loss on one side during a post-number correction after having hopefully taken a larger profit on a winning side. This straddle or hedge strategy consists of both going long and short in the same currency pair before the release of the economics data. Or you can also execute an order to buy at a certain price or an order to sell at a certain price at the time of the economics event. And if the markets surge up, you'll react or you'll trigger that buy order. If the markets fall down, it'll trigger the sell order, and you can have orders to have only one of those two have effect, because you have both of them in, margin dips down, soars back up, and you can get killed greatly. But you have to be able to understand the volatility of the markets. Most of us can't trade in these kind of markets because we can't cover the market volatility. Because if the euro is going to soar up 200 pips, it could soar down 100 pips. It could wipe us out just because we put our stop losses at the wrong place. So it's very difficult to be able to do these unless you have a large enough portfolio that you can actually cover this volatile swing in the marketplace. Okay, so if the number was favorable, often the trader will first take profits on the trade first. This enables the trader to allow the other unprofitable leg of the position in a hedge to decrease the losses. Or you can do something with a sliding stop loss. Constantly move your stop loss up higher and higher or lower and lower to lock in the profits before it declines or every time it moves back up. A variation of this thing involves placing a stop loss immediately on the losing position and wait for the stop loss to be hit. Once the stop loss has been filled, the winning side of the position can be held for additional profits and liquidated almost immediately. So you can enter on either side of the trade. Okay. So learning how to use a straddle is not so complicated. It can be a successful strategy, but you must master it. But this is a great way for trading fundamentals. Then a smarter investor or trader will look at longer term effects. They'll evaluate the fundamentals that come out and determine where the price or the value of that asset should be. Okay, not what's the volatility and what's the knee-jerk reaction. What will the new level of this asset be? So several academic studies have established that the impact of some news announcements have their immediate impact spread over periods of weeks and months, instead of a single day in which the market are thought to discount them. Non-farm payroll report, or to a greater extent the interest rate decisions of the Federal Reserve, are good examples of this kind of news flow. While the markets react violently and unpredictably in the short term, the mechanisms set up by the lower interest rates or full employment have consequences that are relevant to many sectors of the economy, and trading them on a long-term basis is certainly possible. The trader who uses this strategy will build up his position slowly and will attach greater value to low-frequency releases such as GDP reports, and will wait until the overall picture offers clarity before he makes his trade decision. And then, of course, you have the short term. To trade news on a short-term basis, the trader must have a clear criteria of what kind of news will justify a trade. Many news traders seek at least a 50% surprise in data to consider the news release tradable. Okay. For instance, like I said, we had an exceptionally good non-farm payroll report on Friday, but it hardly moved any assets at all. Okay. The novice trader, in turn, can use the initial period of his trading career for perfecting his money management skills. Because remember, when you're trading, especially short-term trading, it's more about risk and market volatility. Covering your risk and knowing what you could lose, okay, and using your proper money management skills. Trading news on a short-term basis can be easy and lucrative if the trader is disciplined enough to cut losses and accumulate products, but panic and mood swings and undisciplined methodology will quickly erase all the gains through shocks and volatility. There are various types of indicators which have the potential to cause the greatest short-term movements in the markets. Okay. So there are lots of fundamentals that you can and should be looking at. You should understand the markets, what the fundamentals are. You should be able to use a earnings calendar. You should be able to use a economics calendar. You should be able to understand how these events all move together. For instance, when we have construction PMI out of the UK, that has a direct effect on certain stocks, and it's mostly home builders or suppliers in the construction industry. So even though you have a strictly government fundamental analysis report, it has a direct effect on the stock market. And this could throw you out of whack if you're just looking at the individual stock's earnings report. Now, this will have a short-term flow, maybe a 30-day effect, but you should be aware of all of these and how they tie together. So hopefully tonight we taught you a little bit about the different ways to analyze markets, the different types of reports you get, and gave you some food for thought. So once again, give Alvexo a try at www.alvexo.com. Set up a demo account. Try using their economics calendar. Try watching a couple stocks or use their advanced charts, and try to see if you can figure out how to trade from the fundamentals. Thank you very much for joining us tonight. Have a great week, and thank you for supporting investing.com. Bye now.